Welcome to Heart of Economy. Today we dive into one of the most critical scenarios in global markets, the real gold panic. In recent days, gold volatility has been rising, but the real issue isn't whether gold moves a few dollars up or down. The real risk comes when everything breaks at once, when all the usual balances collapse together. That's when panic takes over. So, could this actually happen? And if it does, who gets caught unprepared, who benefits, and most importantly, what happens to the financial system when nobody is hedged for a true gold panic? Let's break it all down. Gold normally trades around three anchors: the dollar, real interest rates, and global risk appetite. But the true panic emerges when all three crack at the same time. Picture this: real yields plunge because growth weakens. At the same time, the dollar loses credibility as a safe reserve. And on top of that, risk sentiment collapses across global markets. When these three forces collide, gold doesn't just climb. It rips through every resistance level in sight. Liquidity then evaporates. Yes, the price shows on the screen, but at that level there are no real buyers or sellers. Spreads widen, execution breaks down, and the market suddenly falls into a vacuum. Meanwhile, the options market catches fire. Volatility spikes, and yesterday's cheap calls instantly turn into "I wish I bought more." My take: what defines panic isn't a percentage move in price. It's when flows get locked in one direction and rational decision making is replaced by pure reflex. Now, let's get to the heart of the problem. Is anyone hedged? The truth is, most aren't. First, the traditional 60/40 portfolios. On paper they look diversified. In practice, gold exposure is usually 2 to 3%. That's cosmetic. In a regime shift, it doesn't protect you. Second, yield-chasing funds and traders, especially those selling volatility. Option premium sellers make steady small gains in call markets, but tail risk turns those positions into catastrophic losses overnight. Third, ETF only or physical holders. Yes, spot gold release first, but miners are where leverage plays out, and here costs, energy, and political risks create huge divergences. Ignoring that split is like hedging only half of the risk. And finally, institutional mandates. Many asset managers avoid options because of reporting rules, benchmarks, and regulatory costs. Ironically, that makes them structurally short volatility without realizing it. My view: not hedging is still a position. A portfolio that looks neutral is, in reality, the most fragile. Lately, analysts kept highlighting one strategy: the call spread. Why? Because in panic, implied volatility in gold options explodes. Naked calls become prohibitively expensive. Buying a single call may bleed away most of your gains through premium. The call spread solves that. You buy a call at a lower strike, sell another at a higher strike. That caps upside, yes, but it slashes the premium cost and balances the risk-reward. The disadvantage is obvious: you don't capture the entire parabola. But in a true panic, the name of the game is controlled leverage, not unlimited exposure. My take: in a panic, the most valuable thing isn't cashing infinite upside. It is managing cost and staying solvent. At the core of gold's long-term drivers lies one dirty but powerful correlation: real interest rates. The rule is simple: when real yields fall, gold rises, but the dollar adds another layer. If the dollar itself weakens, due to deficits, debt dynamics, or loss of reserve confidence, gold transforms from a commodity into a parallel currency. Consider what top economists say. Ray Dalio sees gold as an insurance policy and a long-term debt cycle. Mohamed El-Erian warns the old regime is gone, replaced by fragile systems with more frequent shocks. Nouriel Roubini highlights geopolitical fragmentation and fiscal dominance pushing demand into real assets. Jeffrey Gundlach repeatedly stresses the dollar's vulnerability and its bullish implications for gold. John Paulson argues persistent inflation and monetary expansion make gold indispensable. My take, they may use different words, but the chorus is clear. If the system is fragile, hedge while it's still cheap. So, how does panic begin? Several triggers called light diffuse. Data shock, inflation surges while growth collapses, stagflation, real yields drop sharply, gold trips higher. Financial stability shock, regional banks or shadow lenders trigger cascading margin calls, liquidity vanishes. Geopolitical or cyber shock, trade routes freeze, energy supplies are disrupted, or a massive cyber attack hits, safe haven demand for gold explodes. Reserve reallocation, central banks diversify aggressively into gold, ETF flows surge, fueling a feedback loop. My view, it really takes just one spark. True panic happens when 2 or 3 shocks strike together. That's when psychology takes over. A real gold panic doesn't stop at gold. It's a chain reaction. Take equities first. In panic, broad indices like the S&P 500 suffer as discount rates shift and cash flows lose present value. But miners tell a more complex story. Low-cost producers with a clean balance sheet surge, while high-cost or politically exposed miners lag badly. Now bonds, yields usually drop in the initial flight to safety. But if inflation is part of the story, the curve can twist. Short rates rise with policy risk, while long rates fall on growth fears. The fast reaction becomes a wild card. FX is trickier. Normally, the dollar rally is in crisis due to liquidity demand, but if reserve status itself is in question, thanks to that, deficits or geopolitics, then gold steps in as monetary insurance. That shift is profound. My take, a gold panic is never just about gold. It's a multi-asset shock, a systemic repricing across equities, bonds, and currencies. To sum up, a real gold panic is not simply a price rally. It's a regime shift, where flows, psychology, and liquidity all break together. And in such a world, hedging isn't a luxury, it's survival. Dalio's death cycle, El-Erian's fragility, Roubini's geopolitical warnings, Gundlach's dollar outlook, Paulson's inflation thesis, all point in the same direction. When fragility rises, you need a plan. If you found this analysis valuable, don't forget to like this video, share your thoughts in the comments, and subscribe to Heart of Economy. Turn on notifications so you're the first to catch our next deep dive. Thanks for watching and see you next time.